Let me give you a heads up. A tax refund surge is coming in 2026. And for millions of Americans, it's not going to be small. I'm talking hundreds, sometimes thousands of dollars more than last year. And no, this is not speculation. This is already locked into the tax law. If you work overtime, earn tips, own a home, have kids, or you're over 65 and older, this video affects you. I'm Henok Kebede. I'm a licensed certified public accountant and founder of HK Financial Advisory. And today I'm breaking down why a tax refund surge is coming in 2026, who it affects the most, and why this is a one-time situation most people need to understand. In July of 2025, President Trump's One Big Beautiful Bill became law. It was the largest tax overhaul since 2017. But here's the key detail most people missed. Many of these tax changes were backdated to January 1st of 2025. And that single detail explains everything you're about to see. Before we go any further, we need to clear up one really common misconception, and that is a tax refund is not free money, and it's not a bonus from the government. See, a refund is simply means you paid more tax during the year than you actually owed, and the IRS is just returning the difference to you. The easiest way to think about this is through your paycheck. Every time you get paid, your employer withholds federal taxes based on the IRS tables. Those tables are just estimates. They're designed to be as close, but not perfect. So if too much is withheld through the year, the IRS is holding your money interest-free, and when you file your tax return, you're just getting your own money back. That's important because a big refund doesn't automatically mean your taxes were optimized. It usually means you overpaid along the way. Now, let's talk about the real reason this refund surge is happening, which is payroll lag. See, payroll systems don't magically adjust the moment a tax law changes. They rely on IRS withholding tables, formulas, and guidance that take time to update. In early 2025, employers were withholding taxes based on an old law because the new deductions literally didn't exist yet. And this isn't anyone's fault, not employer's fault, not payroll company's fault, not employee's fault. The IRS itself explains this in the IRS publication 15-T, which governs how federal income tax withholding is calculated. When tax law changes in the middle of the year, withholding almost always lags until the following calendar year. So what happened here is simple. For the first part of 2025, taxes were being held as if new deductions didn't exist. Then in July, the law passed, but it applied retroactively back to January 1st. That gap between what was withheld and what you actually owe under the new law is exactly where the refund surge comes from. The IRS already has the money. Filing your return is just the reconciliation. Let me pause you for a second because this is where most people get it wrong. If you're watching this and thinking, okay, so refunds are just bigger now, that's not the right conclusion. What's happening here isn't that taxes suddenly dropped overnight. What's happening is that a timing mismatch between when taxes were withheld and when the law actually changed. And that mismatch only exists temporarily, which means a lot of people are going to celebrate a big refund in 2026 without realizing why it actually happened. And then be genuinely confused when their refund looks smaller the following year. So keep watching because once you understand this part, the rest of the video would make a lot of sense. Now let's shift into who benefits the most from these changes, because this isn't limited to one type of taxpayer. This affects workers, families, homeowners, retirees, and in some cases, multiple categories at the same time. As I go through these, you'll probably recognize yourself in at least one of these categories. Let's start with seniors because this is one of the most straightforward changes. If you are 65 or older by the end of the year, the standard deduction increased by an additional amount for you. So for single filers, that's an additional $6,000. For married filing joint, it's an extra $12,000. And this is on top of the regular standard deduction, not instead of. What makes this especially important is that most seniors already take the standard deduction. So you don't even have to itemize. You don't even have to change how you file. And you don't have to do anything special to qualify. If you meet the age requirement, the deduction is simply baked into your tax return. And because this deduction applies to the entire year, payroll and estimated payments made earlier in 2025 didn't fully account for it. which means for many seniors, this change alone can noticeably increase their refund when they file in 2026. The next group this affects in a big way is tipped workers. Under the new law, tip income now qualifies for above the line deduction of up to $25,000. And that wording matters because this is not an itemized deduction. So that means even if you take the standard deduction, which most people do, you can still benefit from this. Now, there are income limits. So if you're a single filer, the deduction begins to phase out once your income exceeds $150,000. If you're married filing jointly, that phase out starts at $300,000. And once your income reaches roughly $400,000 for single filers or $550K for married couples, that deduction goes away entirely. But for the vast majority of tipped workers, servers, bartenders, and hospitality workers, this deduction can meaningfully reduce their taxable income burden for the year. And again, because payroll systems in early 2025 were not set up to reflect this change, many tipped workers will see the benefit show up later as a larger refund when they file their taxes in 2026. Another large group that benefits from these changes is overtime workers. Under the new law, a portion of overtime pay can now be excluded from federal income tax. So for single filers, the maximum deduction tied to overtime is $12,500. For married couples filing jointly is $25,000. Now, an important clarification here, this does not mean all your overtime pay is completely tax-free. Only the overtime premium portion qualifies for the federal income tax benefit. So Social Security and Medicare still apply, and state taxes may still apply as well, depending on where you live. So what makes this impactful is how many people this touches. So roughly 60% of American workers are in roles that are eligible for overtime pay. So even if you do not work overtime every single week, picking up extra hours through the year can now meaningfully reduce your federal tax bill. And just like other changes we've talked about, payroll systems earlier in 2025 were not built to reflect this yet, which is why many overtime workers will see the benefit later in the form of a larger refund when they file their tax return. Another group that's going to feel this in the big way is people living in high tax states. Under the new law, the SALT deduction cap increased from $10,000 to $40,000. SALT stands for state and local taxes, and it generally includes a combination of state income taxes, local taxes, and property taxes. See, under the old rules, once you hit that $10,000 cap, anything above it, it didn't help you at all on your federal tax return. Now, with the cap increasing to $40,000 though, many homeowners and high-income professionals can now deduct a much larger portion of the taxes they were already paying for anyway. This is especially relevant if you own a home, live in a state with higher income taxes, or pay significant property taxes each year. And just like the other changes we've discussed, payroll withholding and estimated payments earlier in 2025 were still based on the old $10,000 cap. So for many taxpayers in these states, this increased SALT deduction will show up later as a larger refund when they file their tax return in 2026. Another group that's affected by these changes is families with qualifying children. See, under the new law, the child tax credit increased from $2,000 to $2,200 per child. Now, that might not sound dramatic at first, but when you're talking about multiple children, that increase adds up quickly. So to qualify for the full credit, income needs to be under $200,000 for single filers and $400,000 for married couples filing jointly. And just like the other changes we've talked about, this applies whether you itemize or take the standard deduction. Because payroll withholding throughout 2025 did not fully reflect this increase, many families will see the benefit show up later as part of a larger refund when they file their tax return in 2026. The next group this affects is people who purchased a new vehicle. Under the new law, interest paid on qualifying auto loans can now be deducted up to $10,000 per year. There are a few important requirements to be aware of though. So, the vehicle must be new and final assembly has to take place in the United States. The auto loan also must have originated on or after January 1st of 2025, and this deduction begins to phase out once your income exceeds $100,000 for single filers and $200,000 for married couples filing jointly. And just like several of the other provisions we've discussed here, you do not have to itemize your deductions to benefit from this. Because this change also is applied retroactively to the start of 2025, many people who bought a qualifying vehicle earlier in the year will see this benefit reflected later as part of a larger refund when they file their tax returns in 2026. Now, zooming out for a moment, this refund surge doesn't just affect individual households. It has a broader economic impact. So according to the analysis from the U.S. Department of the Treasury and the Bureau of Economic Analysis, we're looking at tens of billions of dollars flowing back to taxpayers in early 2026. That's why economists, including estimates referenced by the Congressional Budget Office, expect this to give the economy a noticeable boost in the first quarter of 2026. Some projections suggest that this could add roughly half of a percentage point to the GDP growth in Q1 alone. And the reason is simple. When people receive refunds, the money tends to get spent fairly quickly on everyday expenses, paying down debt, or making delayed purchases. In effect, this functions like a mini stimulus, but instead of new money being created, it's taxpayers getting back money that was already theirs. And that timing concentrated around the tax filing season is what makes the impact so noticeable. Now here's the part most people won't see coming, and this is where context really matters. In 2026, payroll systems and IRS withholding tables will finally catch up to these new tax rules. That means for many people, paychecks throughout 2026 will actually be larger compared to what they were in 2025. And that's because employers will now be withholding taxes using rules that already reflected these new deductions. But here's the flip side. When you go to file your 2026 tax return, the one you file in early 2027, your refund will likely look smaller than what you see in 2026. And that's not because taxes went up. It's because less money was over-withheld during the year in the first place. So in other words, the big refund in 2026 is largely the result of a one-time timing mismatch. Once withholding becomes accurate again, refunds normalize. So if you remember this explanation a year from now, you won't be confused and you won't assume something went wrong. So let me close with this. A larger tax refund does not automatically mean your taxes were handled the right way. In many cases, it simply means you overpaid throughout the year, and the IRS is just giving you your money back. The real question is whether your tax situation is actually optimized, or whether you're just reacting once filing season shows up. So if you want help understanding why your refund looks the way it does, whether you overpaid or underpaid, and how to plan proactively going forward, you can book a strategy call using the link below this video. That call is designed to give you clarity. And if this breakdown helped you, go ahead and like this video. Share it with someone who might need it, and subscribe so you don't miss any future updates. I'll keep breaking this down as IRS releases more guidance, and I'll see you on the next video.